Hello, and welcome to the Josh Brown Podcast. With over 40 years of combined financial planning experience serving high net worth clients, we will discuss our favorite topics, concepts, and stories.
Hello, and welcome back to the Josh Brown Podcast. I'm Phillip Saunders.
I'm Dan Joss.
And today we're talking about a Dimensional Fund Advisors article written on April 24th. It's titled 3 Common Investing Mistakes. So we'll just be looking through that article and then commenting on it. So the first investing mistake is trying to time the market. In the article, they talk about timing the market, and they did a time period from 99 to 2023. If you stayed invested, put $1,000 in the market, that $1,000 turned into $6,449. If you missed the best week, that turned into $5,382. Missed the best month, that turned into $5,150. If you missed the best 3 months, that turned into $4,546. And then if you missed the best 6 months, that turned into $4,185. So, of course, the emphasis here is just stay invested over the long run, even during periods of volatility. If you miss even the best week, month, 3 months, and so forth, that can really hurt your investment performance.
Yeah, here, if you're out of the market for 6 months and they happen to be the best 6 months, you've missed almost 20% of the return of that 20-year period.
Absolutely.
Yeah. And my experience is with clients, they have a fear that something may happen bad in the market, and so they want to go to cash.
Right.
And so if we let them go to cash, this is what they could lose. It's just likely to go up as it is down.
Absolutely.
For certainly for 6 months.
Yeah.
I mean,
and
if you
a lot
look
of
at
times,
a 24-year period and you're only out 6 months, like, oh, that's nothing. But only in hindsight, if you know that 6 months was the worst 6 months or the best 6 months or just somewhere in the middle.
I think a lot of times clients think back to averages, and it's like, oh, well, the S&P averages 10%. And yes, it averages somewhere around there, but there's when the highs are up, they're really high, and when the lows are down, they're really low. And so all of that averages to the 10%, but you've got to endure that volatility through the way.
Yeah, and that's the average 10%, but I think you could probably find that article that says most of the year's annual returns are either above 20% or below
That's
0.
That's what I'm trying to say. Exactly. Yeah.
So it's rarely ever between 0 and 20.
Exactly.
But it averages 10.
Yeah. Yeah. So it's always variable.
And to guess the future that it's going to be bad puts you in a predicament. Like if the stock is 100 and I think the stock is going to drop to 80,
right,
which would be the definition of a recession.
Yep.
I think we're going to have a recession and the stock market's going to drop to 80. So I'm going to get out. Now, my predicament is now, if it doesn't get to 80, when do I get back in? Right, let's say the market drops to 85. Do I get back in? Well, no, my goal was I wanted to get back in when it gets below 80. But if it starts to go back up and now it's 110 or 120, do you get back in? Because now you're admitting to yourself that you've made a mistake. Or you could hold on and say, well, it's going to go back down to 80 again. Right. And so if you try to guess that the market is going to go down, you have to have a plan for when you're going to get back in.
Yep.
If you're wrong.
Okay, so maybe like a timeline, or if it goes above
timeline is best because the time will pass.
Yeah.
And to say I'll get back in, when it only gets to 90 or 100 or 110, you don't know.
Yep. Yeah.
So we first to not guess.
Would you rather just avoid that scenario?
That's right.
Completely? Yeah.
If you guess, we're going to help you set up a timeline to say, if I make a mistake, this is when we're going to get back in.
Okay.
And we talk with clients about specific stocks about that. Like we have clients that buy their own company stock, regularly.
Right. Yeah.
It's like, if it's 15% off, because that's what most stock purchase plans allow you to do. It's like, well, when are you going to sell those? Well, we prefer to sell that on a discretionary purchase, right? There's no timeline. Like,
Okay.
I'll sell that $20,000 of my company stock when I want to put it towards the purchase of a new car. And if the stock is
Okay.
down in the tanks, well, I don't need to buy a new car. I'll wait until it
Okay.
recovers. And at some point over the next 5 years
Thought you were gonna-
or 10, it'll recover and you can sell your stuff. But it's not
Yeah.
like I need the money and the date approaches.
Okay.
So it's a way of saying, do you want to sell it at a certain time or a certain price? Well, if it's a certain price, then make sure it's not a necessity.
Mm-hmm.
And if it's a certain time, then we can kind of manage the tax consequence of that.
Okay.
So
That's really interesting. Yeah.
'cause there's always some reason to want a time.
There is. Yeah. Yeah.
So you have to have contingencies in place.
That's why. Yeah. That's why a lot of times we focus on that psychology aspect, because money is such an emotional thing, and when you want to buy or sell or whatever, you may be thinking X, Y, and Z about the market and where you think it's going to go, but there's these other factors as well, like, oh, I got to send my kids to college, or I got to buy this new car or whatever, and all those factors come together and influence your decision. So,
and it's not
watch out.
just emotional, but the emotion affects our physical.
Yep.
And that's when we get nervous or we get hot, or now our body's involved with it too.
Yeah, that happens as well.
So we recommend not trying to time the market.
Don't time the market. Yeah. The only other scenario I was going to share was recently with bonds. Did you notice when they cut rates? They recently cut rates.
Yeah.
Long-term bonds weren't really affected.
Yeah, everyone.
And I think most people thought
everyone
that they
thought
would
they're going to
get-
go down, and I'll be able to refinance my mortgage at 6%. So, didn't happen.
Yep. And it may in the future, and we just don't know. It's hard to time. So.
Yep.
Yeah. Okay. So the second mistake people make is focusing.
One more point.
Oh,
There
okay.
is a statistic, and we could find it, but of the professional money managers, how many beat their index? It's few
Yeah,
over
absolutely.
a length of time, and their job is to market time
Yeah.
in some sense, and they can't do it, even with millions of dollars of resources.
Yep.
And essentially open book on companies they're evaluating, talking with the money managers, talking with the producers, talking with the supply chain, all that stuff, and they can't regularly get it right.
Yeah.
A majority of them can't regularly.
And there's just certain things you just can't prepare for. Things like COVID,
Strikes,
strikes,
elections, they all. That's what the markets do. It's everybody's information all together in real time, and unless you know more than everybody, which by definition you can't, then you don't have a shot at it.
And the other thing
that isn't by chance.
There you go.
And you could guess by chance, and then what that would do is reinforce that you're smarter than everybody.
That's exactly. Yep. There's so many money managers out there that probably really get lucky, but we chart that up to, that's skill, so let's put our money with them.
Yep.
It may just be luck after all. So, yeah, good.
What's another common mistake?
The second mistake is focusing on the headlines. And so this article talks about the Mag 7, Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla, and those astronomical returns here recently. And then it talks about the average annualized performance of stocks before and after joining the 10 largest stocks in the U.S., and this is from 1927 to 2023. So their 10-year performance before was 11.8 averaged, 5-year performance averaged was 20%, and then 3-year performance prior to joining those top 10 stocks was 27%. So really high returns.
So if you're averaging 27% for 3 years in a row, you're likely to be one of the larger companies.
Absolutely.
Because of that performance.
Sure.
Okay. So then you're in. Then what happens?
Then not so much. Not ideal. Still okay returns. But so again, this is outperformance. So outperformance after joining the 10 largest stocks was on average, the 3 years was 0.5%. 5-year average, 5 years after joining the top 10, minus 0.9%. And then 10-year average minus 1.5%.
So essentially, once you make the top 10, at some point you just become average.
Exactly. Yeah.
Which means over time we would expect to see, if we looked at 10 decades, we would expect to see different large stocks. Different largest stocks.
Yep.
Yeah.
And these Mag 7, some of them have been around for a while and some of them haven't. And as time goes along, you know, those top 10 stocks get replaced and new things come out. And I think the reasoning for this is most companies just can't sustain that high growth that they've had coming into the top 10.
I remember, and this was probably 20 years ago, Krispy Kreme.
Yeah. Yeah, absolutely.
Had such a high price earnings multiple that it was like they would have had to sell a donut to everybody in the world every day for the rest of
Nice.
the rest of their lives. It's like, that's just not possible.
Right. Yeah.
But that's part of the markets. You know, a company will be in the news, and everyone says, "Oh, let's get that," and then they won't be able to meet all of those expectations.
Yep.
And then they'll fall. And that's what we're seeing now with NVIDIA. It's like, can they possibly meet everybody's expectations forever? Well, maybe in the near run.
Right. Yeah.
And some of this, focusing on the headlines, gets people to thinking, in some sense, stock picking or timing the market. I think that company will do well for the next, 6 months.
Yep.
Or I think it won't do well, so I'll sell it. You never know.
Absolutely. Yeah, it certainly is tempting. You know, you see a company getting returns of, you know, above 50% in a year, and it's like, yeah, I'll join on that train. But yeah, time and time again, we've seen in history where that has run its course.
Then you jump on the train and then it pulls in and stops.
It pulls to the stop, or it starts going backwards on you. Yeah, runs off course.
All right.
And then, the other thing is just generally speaking, most of the growth in companies happens when, you know, at the small level, when they're small companies and they're entering into the market and they're experiencing that growth from small to medium to large.
Yep.
And once they get to that large level, there's just sometimes nowhere to go. You know, they've already had all that growth, if that makes sense.
Yep.
Okay. And then the third mistake, chasing past performance. So in the article, talks about most funds that were ranked in the top 25% in terms of 5-year returns didn't remain in the top 25% of funds for the next 5 years. So all that's saying is, you know, if it was a really good fund in the first 5 years, then a lot of those funds didn't shake out over the next 5 years.
Didn't stay.
So that performance didn't continue. Yeah. 1 in 5 equity funds stayed in the top performing group, and only about a third of fixed income funds stayed in that top group.
So you may do better to pick the top performer and then not own that. Own something other than the top performer.
You may.
Because if 80% of the top performers for the last 5 years aren't top performers for the next 5 years, that means something else did better.
That's right. Yeah. And so the point is just not to chase that past performance. And that's kind of tied to what we were just talking about with the Mag 7, seeing those big returns and then, okay, let's dump all our money in there. That's just not how the stock market works. I pulled up a graph of asset class returns, and so just showing the different asset classes that have been at the top over the years. Mm-hmm. And there's just no way to see any kind of, continuous winner.
Yeah.
It's always different.
And for those of you that want to see something like this, just use your favorite web search and search periodic table investment returns. And you're going to see pages and pages of these types of things. And they'll be split either U.S., international, emerging market, and bonds, or different sectors within the stock market, all kinds of different things.
Yeah.
And there is no pattern. That's the point.
Exactly. Yeah, it's the ones that performed well last year aren't always the ones that perform well this year.
Yeah, and you'll see
So
2 or 3 years of top, and then bang, they'll be down at the bottom, or vice versa.
yeah. So that's one aspect of it is the asset classes. Large caps doing well this year. It may not be the top performer next year. REITs did well. I see here 2010, 2011, 2012, and then they fell off. In the following years.
Well, you may see a trend. The trend would be stocks will have big positives and big minuses, and bonds will have small positives and small minuses, comparatively speaking.
Yep. Yeah, and so that's one aspect of it. The other aspect of it is just the managers, as we were saying earlier. Those managers that have done well in the past aren't necessarily going to be the same fund managers that are going to do well in the future.
Which is interesting. You combine that with this chart, because the fund manager usually sticks within his asset class. And he may be doing really well because the asset class is doing well.
Exactly.
And he may be also then doing really well, but the asset class isn't. So even though he may be the top manager in the asset class,
It might
the
be a
asset
poor
class
asset class.
isn't doing well that year, and
Yeah.
he shows up down at the bottom.
Yeah, that's right. Yeah, and so this is why one of the things with the manager part is indexing has become so popular, is because you can't guess who's going to be the top manager, so why not just put it in the index and just let it go. The other thing that we see over and over again is that fees are one of the largest indicators of performance. And so when you have a manager with high fees, a lot of times it doesn't pan out over the long term, like those low fee
Or
index
maybe
funds.
they can charge high fee because the manager is worth it.
They may be worth it.
But eventually, you have to outperform the higher fee, and that becomes more difficult to do.
Yeah, that's a burden. Absolutely.
Yep.
Yep.
Well, this is great.
Yeah. Anything else to add?
So what do we do to prevent making one of these 3 typical mistakes?
So don't time the markets. Don't focus on the headlines, and don't focus on past performance.
And I would say hire an advisor, and they're going to bring some objectivity to it and help you overcome your emotions to want to do some of these things that's natural for us to want to do.
Absolutely.
Yeah.
Having a second chair just to look over everything and make sure you're not making emotional decisions.
Great.
All right. Well, I think that's it for this time. Thanks for listening. We'll see you next time on the Josh Brown Podcast.
Thank you for tuning in to today's episode of the Josh Brown Podcast. If you'd like to see more episodes, visit our website at joshbrown.com.